A warm good evening to all the participants. Carnelian Asset Advisors Private Limited is a boutique investment management firm founded by a set of industry veterans with the combined wisdom of 77 years of experience. And today they are going to present manufacturing shift, imperative and the opportunity. The manufacturing sector has a potential to reach $1 trillion by 2025. Which is a big draw for the investors now in India. India manufacturing sector is expanding now with the sustained growth. Despite headwinds like inflation, and manufacturers are able to pass on the additional burden to the customers, and it is one of the fastest growing PMI, which is a very clear indication that manufacturers are able to scale up with the sustained improvements in demand and margins. Today's keynote speaker is Mr. Vikas Khemani. He is a Chartered Accountant by education and a CFA Charter holder with over 2 decades of experience in the equity market. His passion is for equity, which took shape in early age. Vikas is one of the most sought after speaker in the various business televisions and lot of contemporary market topics, and respected with corporate India. Vikas practices yoga and meditation, and he is a marathon runner to keep fit, and he is a vociferous reader. Now I hand over the stage to Mr. Vikas to take over and to present the selected topic. After that, we will have a Q&A. It is over to you, Mr. Vikas.
Thank you, 𝐸𝐤𝐤. Thank you for hosting us and sharing this platform with us to discuss this topic with your viewers. This topic has been very close to our heart for last over 15 to 18 months, and and hence it's a very, very big opportunity. So we will talk about it. Friends, I think in markets, as we all know, that whenever there is a very big tailwind about anything, and it's a multi-decadal, multi-year and long decadal opportunity, that is where the significant wealth creation happens. So whenever you get a big tailwind and a crossroad of a good company, that's where I think massive wealth gets created. And in today's discussion, we're trying to kind of and we have a fund around that, but today's discussion will keep more at what is this opportunity, what are we talking about, what is sort of why manufacturing is a very big imperative for India and as well as an opportunity. And as you know, that very big part of any large sustainability of any economy, especially of the size of India, unless it is very, very, very balanced across services, manufacturing, agriculture, and in various aspects, it will always have some sort of challenges. And India has gone through those challenges in the past for one of the reasons that our dependency on the manufacturing side got big time focused on imports. India actually did not pay much attention to manufacturing, specifically in the decade of 2000 to 2000 sort of 10, 12 kind of period. In that period, China was gaining a lot of sort of momentum, and they were building their manufacturing prowess, and India ceded that prowess to them, did not protect the local industry, and hence our dependence on the imports became very high. And that also always exposed us towards our vulnerability. Our current account sort of became very, very imbalanced. Deficit is very high. If you remember, in 2014 13-14 period, when our current account deficit went as high as $80 billion, almost close to 4% of the GDP, we became very vulnerable and part of fragile five. So one side we are dependent on energy imports, gold imports, and on the top of it also manufactured imports for our manufacturing sort of goods needs. So this is a very, very big imbalance, and that imbalance is set to get corrected in post-pandemic, post 2020 period for set of reasons which I will discuss. So, and as you are seeing around us, what today is happening in the countries like Sri Lanka, where they were largely dependent only on the tourism income for their foreign exchange needs, and everything else they were importing from outside, be it manufactured goods or, in fact, to a large extent, a great amount of food grains and energy and everything else. So whenever this kind of tilt is there, any threat to your economy, creates not only vulnerability, which is today Sri Lanka kind of country is facing. It also, so it exposes your country to these kind of shocks, and also, it remains vulnerable in the long term from multiple such shocks. So hence, India went through in 2013-14. It went through in 1991 and 92, and then second time it happened in 13-14 period. So this is the context I want to send, that this is a very, very imperative for India, that we become self-reliant on our needs on the manufacturing front. And as you can see from the data on the chart, that today India's manufacturing is only 16% of the total GDP. So we are predominantly still service-oriented economy, and manufacturing is still a very tiny part. Of services and agriculture makes the large part, but manufacturing is a very, very small part. And when you have a population of this kind, aspiring population with the rising income and rising per capita consumption, which of course very large part will also be manufactured goods. You are, as the income goes up, you are getting more and more exposed to this kind of risk. And hence, and post pandemic, when we realized, I think two things happened around post pandemic. One was De-globalization, which created some kind of standoff for India vis-a-vis China. And secondly, during pandemic, we realized that how our entire supply chain is dependent on one country, and anything specifically some of the critical items like APIs, where our entire medical healthcare system is dependent upon, and many more, even in electronics. Today, nothing can happen without electronics. So all those things are dependent only from China and surrounding countries. So we got really sort of exposed, and that is where I think the whole shift or transition happened. And I think government of India realized that this vulnerability we need to fix with very, very huge amount of urgency and importance. And around that, we saw several measures being taken in last almost 2 years, which is beginning of a very big trend, where India, which was supposed to be only 16% of manufacturing GDP, government is targeting to make it 25%, which is a fairly large and tall ask. But even if you take, let's say, for argument's sake, 20% of the total GDP, which is, let's say we are targeting $5 trillion GDP, it will become $1 trillion. So from $450 billion to $1 trillion itself is a doubling of manufacturing GDP. And whenever this kind of doubling or this kind of growth, pace of growth is there, you see always new businesses getting created, businesses getting scaled up, and massive wealth creation opportunity getting offered. So today we will discuss two things. One is that why this time manufacturing will take place, what are the various drivers of manufacturing for it to happen this time around, and secondly, what are the opportunities within that. These are the two broad things we will discuss this. So with this context, I just wanted to set that there's a huge amount of urgency need, which is felt within the government, within the entire ecosystem, that India needs to be self-reliant, and hence set of measures are being taken, paving the way for this path of accelerated growth in this segment of the GDP. Now let us look at what are the various things being done, what are the various pillars of this particular opportunity. So number one, as I talked about, is that, and it is not only government, there are also enabling factors which is kind of pushing this, but we'll talk each of them. So government, of course, like I was saying, we all know that there's a very big Atmanirbhar Bharat program, which government started, releasing post pandemic, all the measures which, finance minister at that time, consistently they've been coming out with their different measures to kind of make India self-reliant, and PLI being one of the big one. And as we know that the government has announced, close to 2 lakh crores of, PLI incentives, which will kind of build huge amount of capacity in the country across various segments, and government has gone about targeting different segments where India is a lot more exposed, when our needs are very high and we are vulnerable, so that India can become reliant or self-reliant in that. And also where India needs support, because also when we are building, we need to be competitive vis-a-vis our immediate competition. So wherever India needs an incentive, government has provided those incentives, and that's a very big shift. Around that, I think government has also done a lot of sort of other reforms, because it's when you talk about manufacturing, it's not only PLI which is important, right? You need to have enabling infrastructure, you need to have you need to have policy framework which is supporting. So government is work, we have done many reforms around that, whether it is creating manufacturing clusters. You would have heard that, whether it is textiles or many other segments where there are defense corridors are coming, the different clusters being created to promote industries, so that we can create economies of scale in those industries and those locations, and providing supportive infrastructure, whether it is logistics. We are working on DFCC, which is going to go live very soon. I mean, you must have heard transport minister saying many times that they are building an integrated logistics, mode of logistics model, where India's logistics cost can come down, and I'll talk about it a little bit later as well. Mining reforms are being done. A lot of reforms are being done. Infrastructure is being prepared. So all those things are important from a long-term sustainability of building of this practice. Another very important change which government has done, which historically India has never used, this we must understand and very critical, is our usage of non-tariff barriers. So typically, to provide protection to the industry, government uses tariff barriers, meaning they can put import duties on anything which is coming into the country, right? So that it becomes expensive in the country. India historically has used, as you can see from the data, that our import tariffs were high at 17% as compared to most of the other countries. But there's another item called non-tariff barriers, meaning where government put procedural delays, procedural sort of hurdles for things to come into India. And every country uses that to their advantage to protect their industry locally. Like if you see data, China has such almost close to 2,800 notifications. South Korea has close to 1,800. Japan has close to 1,800. India has hardly anything, as you can see from the slide, right? The first time government has said that, India has less than 500. So that we will now use non-tariff barriers, and that is already in place being implemented. The benefit of non-tariff barriers is that, in WTO, you can stand, your argument that you are still not restricting anything, you are not imposing undue tariffs, but you are just making sure that, our country's needs on the quality standards get met, or our country's needs get sort of addressed. So to give an example, earlier power equipments could be freely used in India, imported in India. So all power plants were built using a lot of Chinese equipments. Now, government has put a restriction saying that, of course, you can sell into India, but you need a registration with Power Ministry. Now, those Power Ministry registrations can be subject to many conditions and can take time and can get delayed. Like this earlier, lot of goods in India can be sold without BIS mark or ISI mark, right? Now, government has made, like entire toy industry, if you see in India, all the cheap Chinese toys were imported without any standard, meeting any local standards. But now that has become compulsory. Now, if that becomes compulsory, then people either they have to, the cost of imports will go up, or there will be delays in terms of or procedural sort of hurdles in terms of coming and selling into the market. So these kind of things provide, because demand is going to be there, protection to the local industry, and once your ecosystem gets built, then India can build its own cost advantage and everything else. But you need to have a starting point for building the ecosystem. And that is what this non-tariff barriers ends up doing. And they are, government is very smartly working in many sectors in a systematic manner to kind of provide particular sort of protection to the industry. And this is a very big change, and that's the reason you are seeing lots of entrepreneurs are beginning to now gain kind of confidence and starting Capex cycle in a big way. So this is another point I wanted to make. Other second thing, so government is doing a lot of things, but apart from the government, right, what is another interesting point we must know, that why manufacturing in India will pick up as compared to China. China is always, of course, is a manufacturing giant, and which will continue. I'm not making a case that China will not remain manufacturing giant. But the point is that India's cost competitiveness vis-a-vis China has anyway been improving over over last few years, especially last 5 6 years. And the reason being for that is that China has been rebalancing their economy from export oriented to consumption oriented, meaning they have been increasing their minimum wages over last 5 7 years consistently. So our labor cost minimum wage is roughly about $200, whereas China's labor cost is $800. So, the labor cost is far higher, almost by a factor of one fourth. But even if I adjust for productivity gain, which is very high in China and low in India, still India is far more cheaper than China on a labor cost basis. Power, which has been another very big component of the manufacturing, our power cost and China's power cost is more or less same 8 cents a unit. Of course, right now in last 5 6 months it has gone for a little bit of toss, but I think that is just a temporary situation, and I'm sure the same thing is case in China as well. But point is that historically, Chinese government subsidized power cost and made a lot of industries, viable or more competitive vis-a-vis India, which India did not do. But now I think that those subsidies are going away, and China also is reducing the polluting industries given their commitment, carbon commitment, at the global stage. So to that extent, I think India's power cost is same, labor cost is cheaper. Our logistics cost are a little bit inefficient still, but with the lot of measures being taken as I was talking about, I think they are all getting sort of in times to come we will get better. So, but the point is, the overall nutshell, there are many sectors. India is no longer more, less disadvantageous, less competitive than China, and that is anyway. So, if that is the case, earlier the importers from China, if those goods are available in India, they would prefer to buy here because it's closer back home, less procedure, just in time, all those things can be done. And this is creating lots of industries, encouraging lots of industry to start capex and building. So the cost competitiveness is something which is here to stay, is not going away, and China is anyway becoming more and more expensive by the day. Another interesting point to know out here is that China's currency, vis-a-vis Indian currency, has appreciated by almost close to 18-20% in last few years. That itself is also an advantage for India, especially from an export point of view. So I think lots of advantages are working in favor of India from a cost competitiveness point of view. So it's no more the case how India was very, very uncompetitive as many years ago. In fact, right now it is a case of whether does India have an ecosystem of delivering those goods or not, and that we will talk about in little bit later. Third factor, which is very, very big, is China plus one. I am sure all of you must have heard. I mean, this we put up in 2020, October 2020. Now it has gained lots of momentum. That China plus one. We all know that China is a global manufacturing giant, 28% market share, and the entire world gets fed out of China. And in every boardroom, there is a discussion that how do we diversify away our supply chain from China to elsewhere, right? Because it's a country risk. Given the COVID, what has happened, given geopolitical situation, what is happening, everybody is wanting to diversify, have some more source. And this is where I think India becomes a very, very, very credible location. Of course, we are not making the point that India is the only location. All locations like Vietnam, Bangladesh, we all will be there. But India has unique advantage in many sectors which other countries don't have. Like, for example, our chemistry skills are far, far, far better placed than many other. Our engineering skills are well placed than compared to many other countries. So I think there are certain pockets where India has inherent advantage, which will kind of come back handy. And secondly, there are certain sectors where India is building its competence. Both are going hand in hand, and that's the reason I believe that China plus one is also creating a very good demand environment. And you understand from a business point of view, whenever there's a demand for anything, natural inbound demand, entrepreneurs will rise up to the occasion and kind of create capacity, right? Start looking at it. So earlier, many companies told us when we were interacting that if they were to working with a buyer in Europe or US for let's say 3-4 years, 5 years, despite being at par in terms of quality and cost, still there was a sheer inertia in terms of moving away from China, and it would take 3-4 years. And with this change in the mindset, now that the inertia has become into momentum. So earlier, if you took 3 to 4 years to get your product approved, today you are approving in 3 to 6 months, because there is urgency on the buyer's side. And when this thing happens, Indian entrepreneurs' energy will multiply, and they will kind of, for sure attend to this opportunity and make it a big sort of success out of it. And that is the big change in the environment, which is enabling this opportunity for Indian entrepreneurs. And many of the proofs are there. when we are saying manufacturing, manufacturing will happen two way. One is that lots of local entrepreneurs will put up capacities. Secondly, a lot of global MNCs are going to put capacities in India, as their 100% subsidiary. But that should not be misunderstood that, oh, if there's a 100% subsidiary, how does shareholders or Indian equity investors make money out of it? Whenever a large company puts up a capacity, the entire ecosystem around that is also a very big opportunity. So argument's sake, for let's say Apple is putting up a factory out here, the component manufacture around that also ends up being a very big opportunity. Many of you would recall that Maruti, when it came in India in 1982, 99% parts were sort of imported, they were assembled. But in 5-10 years time down the line, almost 90-95% parts started getting manufactured locally. And that whole auto component industry got built around that. And we know how much wealth has been created, how much opportunity has been created out of auto component industry. So like this, in every segment it's happening. It's happening in defense, it's happening in many footwear, it's happening in textiles, it's happening in many sectors. Many companies are announcing India as a global talent hub. So I think this big change which we are seeing, I think is around the corner, and it's a very, very big sea change which we have seen in especially last 12 to 18 months. So with this context, and other interesting point which I can also make, I missed making that, the fourth point that I would say that India is one place where if let's say any MNC which wants to come and set up a capacity here, they can. India is such a large domestic market that they can cater to the domestic needs as well as make it as a hub for export, thereby creating economies of scale. So you can create global scale capacity, cater to the Indian market and as well as export market. And Government of India is also making it very clear that you have to put up capacities here if you want to cater to Indian market. You must have read in the news that Tesla chose China for manufacturing, and now they are pitching India for reducing the import duty on EVs made by Tesla from China, and India is not reducing that, right? India is saying that we gave you an opportunity to manufacture here. If you want to cater to Indian market, please manufacture here. And that's a kind of approach which is a very, very big, solid approach from our point of view in terms of our self-reliance. Now, it might delay we getting a great cars for a few years, but I'm sure given the environment, given the way the new sort of ecosystem, Tata Motors and others are scaling up, I'm sure huge capacities are getting created. Tata Motors announced a very big Capex in over next 5 years, if I remember correctly, close to 30,000 crores. Now, these are all signs of big companies attending to this big opportunity which is ahead of us. So this is a very Maruti again has made it very clear that 30 to 40% of the turnover will come out of exports from India. So they're making India as export hub. For catering to certain markets apart from catering to local demand. So combination of all these three factors, four factors, we do believe that India is in a manufacturing renaissance. Over next sort of 5, 7, 10 years, India's right now we are in the first phase of sort of attending to the immediate opportunity which is coming. But as the ecosystem builds, as the ecosystem evolves, as our capabilities going to evolve, I think we will start, in fullness of time over next 5, 7 years, also start getting sort of moving into high value added. But right now, even if we capture the low hanging fruit, we will still be, attending to a very big opportunity. We will be attending to a massive sort of wealth creation opportunity. Part of the thing we have already seen in the market playing out in last 18 months. But we think that this is just the beginning of a very, very, very long trend. We should not get confused. We should not, feel that, oh, it's already played out in the next 3, 4 years. In manufacturing, by the time you start doing anything, it really takes between, right now, it's only first new capacities have got unutilized capacities have got used. New capacities will come, new demands will come, new customers will start tapping. People have just started traveling. Pandemic is just got to, sort of around, just sort of settling down. So I think all those things will start playing out. It's a decadal opportunity. I think, as India embarks on, creating our manufacturing GDP of 20 to 25%, we will only know in fullness of time what that number is. But still, it is a massive tailwind, massive opportunity. And initially, I think some of the sectors which will benefit from here are chemicals, APIs, pharma, capital goods. India is also capable of exporting capital goods, by the way. Consumer electronics, durables, auto hands, defense, massive opportunity. And defense, we are not only replacing imports, but we are also now focusing on exporting defense equipment. And this is a very big change, which we never heard. And many of you may not be even aware that India exported almost close to 15 to 20,000 crores of exports last year in defense. So, India has already begun that journey. So, you will see in this, wherever there is an import substitution and exports opportunity, crossroad of these two, I think, both will create opportunity, and there will be many sort of companies within each of them, and more segments are developing, like footwear manufacturing, I think, can be very big in India. Toy manufacturing can be very big in India. So every passing time, you will also see newer and newer opportunity coming, because it's not that these are the only 6-7 sort of broadly sub segments where India will see. As the ecosystem builds, new customers come, Indian entrepreneurs will rise and start building those. As the scale comes, also newer opportunities will come in the marketplace for us to play as an investors. So, another important thing before I say that, it's also important to understand what is the second order impact of this manufacturing. What is going to happen? Two very big change happens that, when your manufacturing GDP goes from $500 billion to $1 trillion, you will create another $500 billion of GDP or revenue. And broadly speaking, in manufacturing, there's a 10% sales to employee cost ratio, or labor cost ratio, right? So you will see 50 to 60 billion dollar of salaries being dispersed into the economy across because of the manufacturing sector in India, which is a very large number. And this job creation is across white collar and blue collar, right? And for to give you some sense how large this number is, I mean, we all know that Manrega, when it was introduced in 2009, it was a very big demand booster in the rural economy specifically, and in the post that 5-year period, all the rural focused consumer community did very well. Our annual allocation of Manrega has been only $10 billion. So manufacturing sector alone will create $50 billion, 5 times of Manrega kind of salary spent into the economy, which is a very big thing. And in manufacturing sector, it is said that for every formal job, there are 3 informal or additional job which gets created of the support system, which again is a very big number. So I think this will be a very big job enabler, job creator of the country. And secondly, another very important thing is that in manufacturing, when you need to do, when you have to grow, you need to do Capex. So for a $500 billion, you will need anywhere between $200 to $250 billion of Capex. Now, when this kind of Capex happen, again, your Capex cycle picks up, and that multiplier effect of Capex picks in. So, manufacturing is not only opportunity within the manufacturing sector, but there's a multiplier impact which keeps on playing out. So I always focus on looking at the second order impact of any big change. So one is that you might make look at the first opportunity, and then what are the second order opportunities out here. So this is how we see that manufacturing over next 5-10 years, a very big structural sustainable theme. In fact, we launched a fund around this theme called Shift Strategy, when we saw 2 very big shifts happening in India. One is manufacturing, and second is technology, IT services, where we saw that IT services, which was otherwise slow growth sector, post pandemic, it became very imperative for every company to spend money on digitization and cloud migration. So that $165 billion of export is set to go to $350 billion. So you will again see that sector doubling in next 5 years. And that's again a massive opportunity. So we saw these 2 very big shifts happening in Indian economy. And in IT sector, again, unlike manufacturing, IT sector, 50 to 60% of salary, revenue gets spent in salary. So if you're talking about another $150 billion salary getting spent, half of that is $60-70 billion, whatever number you can take. So you're talking about another 5 to 6 times of Manrega coming from technology. So these 2 big shifts bringing 8 to 10 times of Manrega into the economy. So we believe that these 2 shifts have not only the ability to kind of create opportunity within those 2 sectors, but also a multiplier effect and revive the entire economy. And that's a very big change which we are seeing. So hence we launched this fund, which is basically investing 2/3 into manufacturing and 1/3 into IT, and across various sectors which I mentioned to you. And idea is to invest into 20-25 stocks, which over a period of time can become multiplier, multi-bagger, and many of them have done well. So to give you some sense, we invested in companies like KPR Mills, Praj Industries, Tube Investments, Anup Engineering, Laurus Labs, many of those across various sub-segments. In IT, we have invested into HCL Technology, even invested into Mastech. So invested into many companies which basically can take benefit of this whole cycle. So, of course, you need to research on the management, you need to research on the business model. Those things don't go by. But if you can look at an opportunity with the perspective of a big tailwind, then that becomes one filter. And of course, you have to go and identify right set of management. Just because there's a tailwind does not mean that everybody will benefit or everybody will benefit to that same proportion. Some companies will make a very big opportunity out of it. Some companies will not at all attend to it. So hence, those basic things have to be done. And so this is what I had to share. I think Sivaram allotted me 30 minutes. So I just didn't want to kind of, but I just want to conclude by saying before I take questions that it's a very, very big opportunity. And I think in such a short period of time, I think we have also done reasonably well. This is our performance of the scheme, which is, I think, delivered 55% CAGR return on absolute basis, 100% return versus index of 55%. So it's basically a very, very focused strategy, and a little bit of portfolio attributes. Our portfolio ROE of the companies is 20%, portfolio earning CAGR is 26%, our portfolio P is 19 times, and portfolio beta is 0.94. So it's a very high quality selected companies portfolio, which we think over a period of time can deliver a very, very sort of superior return, risk adjusted return, and many of the companies will become multi-bagger in fullness of time. So this is what I had to sort of share about this whole big decadal opportunity. Happy to take questions.
Because it was a really insightful presentation, and we have some interesting questions which we got from the investors. The first question is very interesting. How is the manufacturing theme is progressing in back of confluence of all the factors we have discussed here in the presentation: government reforms, cost competitiveness, China plus one shift, etc. Seeing any of these reforms on the ground? Are you seeing all the reforms on the ground? Of course, PMI of 54.6 for the month of May is a good parameter. And do you want to throw more light on this?
So, like I said, that whatever I have shared with you, it's not a theoretical sort of assumption or hypothesis. Hypothesis. We have spoken to maybe over 100 plus companies, collected data. What are they seeing? What are they believing? We have spoken to government officials. We are reading what government is doing. So it's not that one fine day we just decided. So we have done a lot of research on that, and we are seeing ground level data. Some of the companies have shared anecdotally with us that one company was telling me that earlier it took him 5 years in Germany, one customer to get, and he was chasing them, and he would never sort of get that order, despite admitting that he's very good at the product level. And in the pandemic, this Samne came and kind of gave him an order, approved his plant in 3 to 6 months time. Now that clearly shows you China plus one, right? That clearly. So there's an urgency in many chemicals companies. We are seeing customers are coming and giving, here's the money, here's the technology, and here's the order. Please make and give. This kind of things happen when there is urgency at the end of the customer. So I think we are seeing from when we talk to companies, there's a huge amount of urgency which is happening on the customer side. And one thing I believe, when the demand environment is strong, and that demand environment could be for many reasons. It could be either because of government policies, or it could be because of the diversification policies of the companies across the board. When there's a good demand environment, all entrepreneurs rise up to occasion and they figure out and they manage what needs to be done. If they need to even manage a little bit of bureaucracy, I'm sure they will do. So we are not making a point that India bureaucracy is over, everything is great, you don't need to fight anything. Still, I think, we are a work in progress. I don't think, there are states where things are very good, there are states where things are not so good. So, you still have to work through those systems. But fact is that when the demand environment is there, Indian entrepreneurs will rise up to occasion and attend to this opportunity. So that's how at least we see, so there's a lot more ground evidence in terms of what's happening is.
That is very good. And the second question is, how are you seeing supply side challenges affecting overall manufacturing sector? And what is your sense? How long will this take to settle down? the supply side challenges, I mean?
So look, again, supply side disruptions, we don't know. I mean, right now, world is in a very chaotic situation. Still some time ago, China was fully locked down again, second time, or at least some part of China was locked down. So I think things are pretty chaotic, but one does not know. But I would assume that this supply side disruptions has only escalated the risk management matrices of all the companies who are outsourcing from somewhere else. And to that extent, the diversification needs goes up. So here today, people are not looking for that, let's go to India if it is cheaper. People are going to India because it's also imperative on their part that they need one more source. So even if India, let us say for argument's sake, not so cheaper, still people will outsource from here because it's no more only about the cost. So this supply chain disruption, what's happening is only escalating or heightening the need. And I don't think even if once the supply chain issues become streamlined, it will again go back to the normal. Because once the whole, once a supplier buyer starts buying from two sources, they won't change unless something is, unless your Indian counterpart messes up something big way, they will continue with it. So it's basically about, this supply chain disruption is giving an opportunity to be part of the system and start supplying, and that's how I see it.
The third question is very interesting. Does increased de-globalization helps the manufacturing sector more and more now?
So we all know that the de-globalization is happening in last 20-30 years. China fed the whole world using various things. They've created global scale capacity. They brought prices down to that extent. It was deflationary. But I think de-globalization has been in works for last many years. Pandemic has only escalated it. Today, there's a lot more noise in every country happening in terms of having this, self-reliance. So to some extent, I think yes. But India, good part about India is that India is a huge consumption market, right? If forget about exports, even if we can become self-reliant only for our own needs, we are good on manufacturing. Our manufacturing targets will be met. But of course, it's not so easy and it can't happen overnight. It's a decadal process. So I think currently both combination of export and import substitution, in my opinion, is good. And today, even in deglobalization, today, let's say for argument's sake, America, if they want to manufacture something, it is just impossible for them because their labor costs are so high. A trucker in US recently got hired at a salary of $100,000. Now, how do you compete with that cost in China, India? Somebody can, I'm sure, we work at $200 a month, right? So you can't compete those cost structures. Even if tomorrow America wants to manufacture, it's impossible for them to manufacture. So while deglobalization will happen in some of the high-end manufacturing where labor costs are low, automation can be done, but still a lot of automation has cost, and secondly, many things can't be even achieved through automation. So I think India still has that sweet spot where we can use our huge amount of army of people to employ them and deliver to the goods to the world. China has migrated from $200 to $800 of salary, right? India still is there. So maybe 5 years down the line, we will also start becoming competitive. But till then, we have a very good opportunity in the middle of this whole thing to attend.
The next question is, everywhere across the world, the interest rates are hardening. This will squeeze margin, and will it affect the private capex in India?
So good part is that I think everywhere globally interest rates are rising. So it's not only India specific phenomena, but good part is that this time around India's cost of capital is rising lesser than the rest of the world, and to that extent, it's again advantageous for us, right? I mean, in US, even if you today, I mean, I was talking to a friend of mine, his mortgage loan in US dollar terms is at 5.5%. In India, we get at 6.5%, 7%, right? Now you can see where is the cost of capital, and in US it is still going up. In India, we are talking about only 50, 60, 70 basis point increase. In US, they are talking about another 100 to 200 basis point increase, right? So I think to that extent, I think again it works in favor of India. And secondly, why we do not need, why this time around our cost of capital is not as high, and we don't, it's not a big worry for us, is because we are no more dependent on external capital for our needs. Please understand that historically, India's vulnerability has always come from our current account deficit. which still is high given recent, energy prices rise. So our energy prices are with vulnerability. But if I were to park that for time being, because that's just because of this conflict. But just think about it. India is going to gain our current account deficit is roughly about 2.5% of GDP, which at the bottom was 1% and the peak was 4%, right? If because of manufacturing and IT, we have $165 billion of export, which is going to go to $350 billion, right? So India is going to earn $150 billion of forex from IT. Manufacturing, we will import less, export more. So another $70 to $80 billion impact can happen at least, and maybe more, only to. So our total delta because of these trends is going to be $250 to $300 billion, whereas our current account deficit is only about 30-40 billion dollar. And right now I just take the time last 1 month number out, but on an average around 30-40 billion dollar. So today our capital flows, our reserves are so strong that we don't need to depend on external capital for so hence if you see, despite high fiscal deficit, our interest rates costs have not gone up. Today also we have ample liquidity in the system. So right now RBI is tightening only because it has to be seen fighting inflation, right? And that inflation, to be very frank, in my opinion, I'm not sure can be fought with when the energy prices, because the source of inflation is very different than only the cost of capital. But of course, RBI has to do that. So according to me, our cost of capital today is far better placed than a lot of people. But having said that, as long as it goes up for everybody, it should be okay.
See, the next question is the extension of the last question. Are you seeing in the ground level, the public, that is government capex is very clearly seen. Do you think the corporate are still hesitant to go out and create capacities, or they will? Do you see green shoots here?
No, I think very clearly there's a big change which has happened in the environment where corporates are announcing capacity. We saw Kumar Mangalam Birla saying that we are in the middle of a Capex Mahotsav. They have, and each of their company, whether it's Hindalco to Ultratech to everybody has announced Capex cycle. Jindal Group has announced major Capex cycle. Reliance has announced major Capex cycle. These are the big names, and there are many large houses have announced Capex cycle. But another interesting data point I must tell you that there are lots of mid and small enterprises which are announcing Capex between 50 to 100 crore to 500 crore kind of size. Recently, I was listening to ABB chairman, and he was saying that historically, as a part of their business strategy, they always focused on big ticket Capex item. He said this time around, they are seeing massive, and they have a very big focus on the MSME Capex cycle, because his view was that that's a very, very big, large Capex cycle going to take place, where a chemical company is going to put 50, 100, 200 crore Capex, or like this, many companies are coming in a smaller ticket size, and that's a very big opportunity. So I think when somebody announces 10, 20, 30,000 crore Capex, it can be seen, but when somebody announces 200, 300 crore Capex, it's not noticed. But the sum total of put together is generally very high. It's also reflected into the order book of the capital goods companies. Right now, we are having a bit of a challenge. Some amount of order book is getting postponed because of the escalated commodity prices. Because it is very natural that if your project cost is 100 and in no time it has gone to 150, you are bound to relook at least given the short-term escalation in the commodity prices. So you might see a delay of 3 to 6 months till the time commodity prices settles. And but I have no doubt in my mind that we will continue. You cannot achieve your 20% target or 25% target of manufacturing GDP without having Capex in place, because in manufacturing you cannot do anything without having Capex.
With the large PLI schemes of the government, it is unfolding very well in different sectors. And what do you think the government should do to make it secular?
So again, government should be providing enabling infrastructure, enabling environment. Historically, see, one is you need PLI to kickstart. Once it is kickstarted, our entrepreneurs are very, very strong, smart to attend to. I mean, I don't believe that we can't meet quality standard, we can't meet global standard. We can do all of them. Historically, in the past, we had seen always sort of unfair competition coming from outside and killing our local industry, and government did not do anything. So I'll give a very interesting example. India was always self-sufficient in fermentation-based APIs. Till 2005-6, India was fully self-sufficient, and we had lots of manufacturers in China. Took a strategic decision in their own country that they want to capture this market share and go global and kill industry everywhere else. That point in time, the pricing of fermentation-based APIs was in the range of $20-25. China took, based on the government subsidies, the price down to $9. And what happens, and started dumping into India and elsewhere in the world. And China dumped, but our government did not react and do anything. It let it continue. And as a result of that, the entire API industry, especially in the fermentation base, got killed. I had a company, client who had shut down his plant and converted it into a real estate project in Baroda. Because it was not viable. How long company will lose money? Right, when somebody is competing, using government subsidies or government support. So our entire industry got killed, and we became dependent on China. Today, the government of China, or whatever, the Chinese companies have taken the price back to $35, but the entire industry is in China. So what we need to see is the government, whenever such kind of unfair practices are being, followed by competing countries or somebody, we need to have that kind of support system to protect our local industry, which this time around government seems to be fairly determined to provide that kind of environment. So to my mind, this is a very, very important thing. So, and this one example tells this, by the way, did not happen only in this case. It happened in many industries where our companies did not get protected, and government of China played very smart game from their point of view, that where they capture the global market share. Today they capture 100% market share of the container across the globe. Why? Containers are not so complex to manufacture, but they do. But they worked out of a strategy, and as a result of that, but a country like China can do that, but a democratic country like India may not be able to do that. So that's how the difference is. So this time around, at least government is very, very sort of focused on that. Like you must have heard earlier, we have a FTA, free trade agreement with Thailand. And when initial part of this thing, a lot of Chinese goods started coming via Thailand using that agreement, and so that they can contravene take the benefit of the duty. Government immediately plugged that loop and saying that, if it is coming through some other country, Thailand has to have 35% local value addition. Now, if it is only routing, how will you have 35% local value addition? So a lot of these kind of measures are being taken by the government to kind of plug the loophole, which, everybody can use and will be using as and when the opportunity presents. So I think this time around, at least we are seeing a good change. And as long as the government is creating this, efficiency, in the infrastructure, logistics cost bringing down, power cost bringing down, all those things, I think government has to provide, and as it keeps on happening, I think we will become more and more competitive. Lots of industrial parks are being created, lots of supportive policies being created, like textiles. India, despite being 1/3 in the labor cost, garmenting India is still not very big. Not because we did a research, not because, China has 35% market share in garmenting. Their labor cost is $800. Our labor cost is $200. Why still we don't have market share? When we were seeking answer to this question, what we got to know is that it is not about cost. It is about, if suppose, in India, we have only cotton-based fiber or a cotton-based product, but we don't have man-made fiber, which goes into, making a lot of fashion garment, which China is excelling at. They have a parts where they can get all kind of man-made fiber, buttons, zips, just in time. India does not have that enabling infrastructure. So even if I want to manufacture, I cannot manufacture because I don't have just in time for those kind of enabling infrastructure. So I think, and now government is building, 5 textile parks where they will create this kind of infrastructure. So they take time to build, but I guess, it will happen in fullness of time.
You have explained it very well, Vikas, and still some doubting Thomases are asking, the China plus one is secular for next few decades, or is it transitory? As he feels the policy of China can be changed by 12 guys, no parliament, no legislation, nothing. And can they do somersault?
Correct. No, very good question. I think it's a very good question. So first of all, I don't think it can be reversed. It's a decadal for simple 2 reasons. One is that, please understand, China's labor cost has gone up from $200 to $800. In 2012, their cost was also $200. So it has gone as a part of their overall economic design. It has not happened by some accident. Okay, basically China wants to rebalance their economy. They want to reduce dependence on export. They want to increase local consumption, and that's how. And one of the way of increasing local consumption is to keep increasing the minimum wages so that people get paid more and they consume more, and that's how they are lifting the living standards of the population. Secondly, China also wants to migrate away from the highly polluting industries. Uh, uh, so you must have heard that steel plants are being shut down, especially the the blast furnace kind of which are more polluting. They are being shut down. So lots of low and high polluting industries are being shut down by China. They want to sit away those industries, and China wants to go more and more into high value added industry because they are also very reasonably tech focused, and which is part of their design now. But this definitely leaves vacuum for those industries which they are vacating, and that creates opportunity for China, India. Thirdly, China sets their currency, by it's not market driven. It happens sort of they set the currency value. Now, if they have let the currency appreciate by close to 18-20% in last few years, knowing very well that India will get benefit of that, it clearly shows that they are very comfortable letting go of that market, that much part to elsewhere, especially India, because it does not matter to them where it goes as long as they don't want to do it, right? So I do not see I mean, there will be some sectors where they will still have strategic input and they will not let that go. And to that extent, India will have competition. But there is a very large segment of industry where India can right now attend to that low-hanging fruit, which is still, in my opinion, a 5-7 year good opportunity, which will bring lots of people out of poverty, create jobs for India in manufacturing. So that's how I think what China went through in late 90s and early 2000s. I think India can go through that.
One more question has come, and this is also on the issues on the theme. And in fact, auto is still grappling with the chips issue, capital goods with inflation, wherein the corporates have, this question was covered. What he is asking is, which pocket is very clearly seeing traction for you in the theme of manufacturing is what he wants to.
So like I said in our presentation, all, including APIs, chemicals, specialty chemicals, we are seeing good traction. We're seeing, reasonably good traction in capital goods. We're seeing reasonably good traction, on auto component right now is slightly slow given the chip shortage. But in my opinion, that creates also very big opportunity because chip shortage is not going to be remaining forever. It might get over end of this year or maybe early part of next year. But once that happens, you will see a sudden sort of jump in the demand. So, auto component also, and there are companies which are, doing well in that segment as well. So, that remains very, very big opportunity. In consumer electronics, there's a very big opportunity happening. So across the board, you are seeing, wherever there's an import substitution and export opportunity, you are seeing these kind of opportunities. And newer segments are sort of appearing. Like I'm telling you, China is a very big player in toy manufacturing, almost close to $35 billion. It will have to happen in India, in my opinion, in some time, because India is very good in plastic molding and doing a little bit of those work. So it will happen. But today there are not many companies which can be played. But in my opinion, it will be very big. So like this, some segments are already there, some are developing.
The next question is from Krishna Nair. Can we upscale in electronics manufacturing in India? Basic products like Bluetooth handsets are made in China, which is still big. What is your input?
So we will rather, I have no doubt in my mind that India will pick up, like I was giving an example of Maruti, right? In 1982, who believed that India could be very good in auto components, and also today, companies like Tata Electronics are putting 5,000 crore Capex in Tamil Nadu just to manufacturing electronics. We are, right now, I think that some of the companies are putting up even, including, Vedanta and all those things on semiconductor chip plants, right? So again, like I said, I have no doubt in the capability of Indian entrepreneurs and Indian, professionals to build. We can do everything. All we need is supporting environment and the demand environment. And that is kind of there. It might not happen at the pace and speed we want, but it will happen. If Tata Electronics is putting 5,000 crore Capex only manufacturing electronics and electronic components, they are going to replace some of the imports for sure. They are just not, doing it if Apple is putting a very big manufacturing capacity here, initially it might just get imported, but eventually those components will start finding local manufacturing, because local manufacturing will obviously be more competitive than just only imports. And it is Indians are very good at doing value engineering, and we have displayed that in every segment, especially in the chemistry and engineering side, where we can kind of reverse engineer and we can kind of always deliver the best goods comparable with the global standard. So I see no reason why that won't happen.
Vijay Kavasari, sir, I am reading it. Sir, it is out of syllabus question. And when do you think the FIS will make a comeback?
I will let you know when they will make comeback, but so, again, we should not. Good part is that despite such a big selling, of almost close to $20 billion, Indian markets are holding on very well. That clearly shows that our dependence on FIs have gone down significantly, which, in my opinion, is a very good. I'm a Swadeshi man, so I mean, I feel when our so far historically in last 20 post 1991 till 2010 or 15, lot of liberalization benefit went to foreigners, because they were the biggest, apart from promoters, they were the biggest owner of equities. Today, I am so glad that they are selling and Indian retail is buying, because ultimately, as the India's economic renaissance plays out, this retail investors or local investors needs to create wealth and make money, and this has happened in every country. It has happened in US, it has happened in many other countries. Why it should not happen in India? So I'm not really worried. If they come back, I think, in my opinion, whenever the interest rate environment settles down, because in India, most of the FIs come through as a part of the emerging market basket. And whenever Fed increases the interest rate, it's a very natural tendency historically to pull out money from the emerging markets. And that is what is happening right now. So hence you are seeing big outflow. It's not some negative judgment on India. In fact, if you see, FDI flows in India has been highest, in last couple of years. That clearly shows that, because that money is not more long term, that money is where they're putting investments on the ground. They're not putting in the market, which they can take away at the change of their mind. In FDI, you can't just take away the investment at the change of your mind immediately. So that's a lot more sticky and solid. So I don't think you should judge this with any judgment on India. It's a more overall part of the portfolio allocation. And I'm reasonably sure once the global environment settles down, interest rates peaks out. And that's when, and I don't know when that would be. It could be this year, it could be early part of next year. That I don't know. But whenever that happens, you'll start seeing flows coming.
Famous veteran investor told, whenever they come back, they will have a painful re-entry, is what he was telling. It was a very interesting observation I wanted to share here. Because next question is from Nirav Shah. How do you see textile manufacturing as an opportunity, with specific reference to geopolitical situation and strategic benefit? What kind of strategic benefit India has over others in the textile manufacturing?
Like I said, that I explained that in my comment, that garmenting is a very big opportunity. India's labor cost is cheap. Our cotton-based ecosystem is well in place. That's reason, we are doing very well in cotton-based exports. Man-made fiber-based exports are still a struggle for us. That will take some time. We need to have a full ecosystem getting built. But good part is that those ecosystems are getting built. Now that will take 2 years or 5 years, I have no idea. But incrementally, I know that garmenting, India will become reasonably good, big beneficiary.
Can be extended by 5 minutes. Some more questions are coming because the scheduled time is over. Can we extend it by 5 minutes?
Yeah, I'm good.
Sure. Thanks. Okay. And IT stocks have corrected recently. What is your view on mid and large cap IT stocks as they have corrected steeply in the recent past?
So IT, again, so one of the sector I briefly alluded that, there's a huge demand which is happening. There's no company today which can afford not to do digitization and cloud migration. They have, because post-pandemic, that's a very big change which has happened. So if every company is forced to, go that migration, who's going to do it? It's only Indian companies, right? So the demand is global, but supply is only Indian companies. So, and these kind of transformation and transition don't happen overnight. You can imagine in any company you work for, or that if the whole system has to be kind of migrated, database has to be reorganized, they will have to happen, in over a 2 to 3 or 4 year period. So I think this demand is going to be very strong. Every company is guiding goods demand environment, including 2 days ago, Infosys continued to said that in the analyst meet that demand environment is very robust. Attrition issues have been there in the industry, which I think with the startup ecosystem coming down, a lot of demand, a lot of layoffs are happening in the startups. And as a result of that, that attrition problem also seems to be settling down. But companies are expecting that next 2 3 quarters, attrition will settle down and they will get back to sort of normal trajectory. And these businesses are very good businesses, historically, with free cash flow generation, high capability. So I mean, we like IT as a sector. We think that expecting 15 to 18% return over next 5 years should be a very, very comfortable sort of delivery from the sector.
My apologies. Last question was asked by Kumar. I forgot to mention his name. Sorry, Kumar. Okay. And again, Nirav has come up with a new question. What opportunity do you see for India in man-made fibers? Man-made fibers.
So I think it's not about somebody stopping us from getting this opportunity. Fact is that because China was playing a very big role in that, our cost competitiveness was low, and hence capacity didn't get built. If you see in the polyester side, we have only 4 or 5 players, and nobody in last was willing to put up capacity. At the same time, no banks were willing to fund, because historically, they were competed out from by China, and only large players like Reliance could sustain. So I think now that is beginning to change, and we are beginning to see some amount of Capex being announced. It will take time. It's again because once bitten, twice shy. So people in the man-made fiber side has kind of lost or suffered so much. It's very much like similar to APIs, by the way. In APIs, companies have been struggling for last 10-15 years to kind of gain size and scale. And now with the demand environment, every company is beginning to look at fresh approach. So I think likewise, same way will happen in my opinion. It's a slow risk coming back on table, and that is how companies will attend. So I see it will change slowly.
Last question for the day we will take with us. He is asking, sir, you're a marathon runner. It is nice to hear from Shivaram that you're a marathon runner. For this theme to fructify, how long the marathon will be for us? Time horizon is what he is asking. What kind of time horizon we need to give for this theme to play out to make returns? Is what he is asking.
Team will be playing out. It's playing out, is underway. But in my opinion, at least you should have 5 year perspective. And if you take a 5 year view, in my opinion, we'll all will be positively surprised. If you take a 5 year view, I think generating very, very handsome beyond outperforming index will be very, in my opinion, comfortable. In general, I am very, very positive on India. For the reasons I told you, that our banking sector is very sort of well consolidated, ready to grow. We are very under leveraged country on a domestic, with a corporate level, at an individual level, at a government level. Our manufacturing sector is coming back, IT sector has come back, real estate sector, which was there in difficult times. Most of the cities are sitting on all-time low inventories, and now the new inventory getting created, and the jobs which I talked about, if they were to get created, people will buy homes. And as people buy homes, there will be multiplier demand. Infrastructure, we all know that government is spending money massively on, across the board, roads, ports, railways, everywhere, right? So combination of all these things put together, I always believe that in my career of 25 years, I haven't seen so many confluence of factors coming together, pointing in the same direction. So the multiplier factor or amplifier factor will be far, far higher than, what we have seen in the past. So, I do believe that we are in one of the best time for India, from next 5 to 10 years perspective. And, there will be, of course, better opportunities. There will be, volatility like we are seeing right now. there will be volatile periods, so it's not going to be playing out one way. But for a patient investor, which takes 5 to 10 years perspective, I have no doubt in my mind that there will be massive wealth creation opportunity, in this theme and in general for India.
Mr. Vikas, it was wonderful. And in fact, we had an opportunity. You are so busy and you have agreed for this webinar. It's a privilege for us. I want to thank you on behalf of the investors and PMS Bazaar family. And thank you very much, investors also who have joined this webinar. Thank you very much to all.
Thank you. Thank you, Sivaram. Thank you, PMS Bazaar. And thanks everyone for patiently listening to me. Feel free to reach out to us if you have any more questions. We look forward for many more such interactions. Thank you.